Wheaton Precious Metals operates in the precious metals streaming industry, a sector defined by its ability to provide high-margin exposure to commodity price appreciation while maintaining a risk profile significantly lower than that of traditional mining entities. The corporation operates as a specialized financier to the global mining sector, offering upfront capital to operators in exchange for the right to purchase a percentage of future metal production at a predetermined below-market price. This analysis provides an evaluation of the company's financial health, with a specific emphasis on the mechanics of its cash flow generation, the robustness of its balance sheet, and a valuation assessment. The streaming business model, operational and financial mechanics. The fundamental proposition of Wheaton Precious Metals is built upon the structural advantages of the streaming agreement over traditional equity or debt financing for mining companies. By providing non-dilutive capital to mining partners, the firm secures long-term access to precious metal production, often as a byproduct of base metal mining, at fixed delivery payments.
These payments are contractually defined and typically consist of an upfront deposit followed by a per-ounce payment upon delivery, which is usually the lower of a fixed dollar amount or a small percentage of the prevailing spot price. This model creates a significant levered effect on profit margins. Unlike traditional miners who must navigate rising costs, the company's costs are largely isolated from mining sector inflation. Consequently, when metal prices increase, almost the entirety of the price appreciation translates directly into incremental operating cash flow. Furthermore, the company benefits from any exploration successes or mine expansions funded by the operator at no additional cost to the streamer, providing organic growth without the associated capital expenditure. The efficiency of this model is evidenced by its low capital intensity, as capital is primarily deployed through upfront payments rather than ongoing maintenance. This allows for a mitigated operational and geological risk profile compared to traditional mining, as the company does not bear the full weight of site-specific challenges. As a result, the organization maintains industry-leading net margins of approximately 55%, a figure that typically outpaces the cyclical and cost-sensitive margins of capital-intensive miners. The company also maintains a highly diversified portfolio, with over 23 operating mines, providing a broader base than many traditional mining asset holders.
Strategic advantage over royalty structures. While often grouped with royalty companies, the streaming model employed by the organization offers distinct advantages, particularly regarding cash flow predictability and capital efficiency. Streaming agreements involve the actual delivery of physical metal, allowing the company to control the timing of sales and capitalize on market demand through marketing and sales strategies. In contrast, royalty companies typically receive a percentage of revenue or profit, leaving them more exposed to the operator's accounting and cost control efficacy. The produced but not yet delivered (PB&D) mechanism within streaming also provides a lead indicator of future revenue, allowing management to forecast liquidity with high precision. Operational performance and production trajectory. The operational results of 2024 and the first 9 months of 2025 demonstrate a company entering a period of significant volume expansion. In 2024, the company exceeded the top end of its production guidance, delivering 633,481 gold equivalent ounces (GEOs). This momentum carried into 2025, with third-quarter production reaching 173,400 GEOs, a 22% increase year-over-year. Core asset analysis, Salobo and Antamina. The Salobo mine in Brazil, operated by Vale, remains the most critical asset in the portfolio. The completion of the Salobo 3 expansion has been a primary driver of recent volume growth. In the first quarter of 2025, Salobo produced 71,400 attributable gold ounces, representing a 16% increase from the prior year. The final expansion payment of $144 million was made in mid-2025, confirming that the mine has reached the sustained throughput levels required by the agreement.
Antamina, a top-tier copper-zinc mine in Peru, owned by a consortium including BHP and Glencore, is the primary source of the company's silver production. Silver production at Antamina is forecast to increase in late 2025 as the mine reaches higher-grade silver zones. A $2 billion expansion project is currently underway at Antamina to increase copper production by 20% by 2026, which will simultaneously lengthen the duration of the silver stream. Diversified asset status and emerging production. Beyond its core assets, the company benefits from several established and emerging operations. Peñasquito in Mexico, operated by Newmont, continues to be a key source of attributable silver. Similarly, the Constancia mine in Peru, operated by Hudbay, provides consistent gold and silver production. A cornerstone of the 2025 performance has been the transition of development assets into producing mines. Artemis Gold's Blackwater mine in Canada announced the commencement of commercial production in May 2025, with mining operations reconciled favorably against resource models. Blackwater contributed 6,400 GEOs in Q3 2025 and is expected to ramp up production significantly toward the end of the year. The Goose project, part of B2 Gold's Back River Gold District in Nunavut, achieved its first gold pour in June 2025, with operations currently ramping toward full commercial capacity. These projects are critical because they represent fresh cash flow streams that have already passed the highest risk construction phase.
Long-term production guidance, 2025-2029. The organization has projected a growth profile, anticipating a 40% increase in annual production to 870,000 GEOs by 2029. This growth is backed by a pipeline of 9 assets that have already received key permits and are in various stages of construction or expansion. Beyond 2029, the long-term outlook remains robust, with an average annual production forecast exceeding 950,000 GEOs for the 2030-2034 period. Cash flow analysis. The financial strength of Wheaton Precious Metals is best reflected in its ability to generate massive operating cash flows while maintaining low capital intensity. The 2024 and 2025 fiscal years have set consecutive records for cash flow generation, driven by the convergence of volume growth and high realized prices. Operating cash flow dynamics and margin expansion. For the first 9 months of 2025, operating cash flows reached $1.1587 billion, representing a 63.6% increase over the $708.1 million generated in the same period of 2024. In the third quarter of 2025 alone, operating cash flow was $383 million, up 51% year-over-year. This growth is a direct result of the cash operating margin, which reached $2,930 per GEO sold in Q3 25, a 41% increase from $2,171 in Q3 2024.
The expansion of the cash operating margin is a critical metric for investors, as it demonstrates the efficiency of the streaming model. Because the delivery payment, or cash cost per ounce, remains relatively stable, increasing only slightly from $439 to $532 per GEO year-over-year, almost every additional dollar in the spot price of gold and silver flows through to the bottom line. Produced but not yet delivered, PBND, and working capital. The management of working capital is centered on the produced but not yet delivered, PBND, account. This represents metal that has been produced by the mining partner but has not yet been sold by Wheaton, creating a timing lag between mine-site production and corporate revenue recognition. As of September 3, 2025, PBND stood at 151,800 GEOs, which is at the upper end of the company's target range of 2 to 3 months of payable production. This inventory build is typical during periods of production ramp-up at new mines like Blackwater and Goose. Investing and financing cash flows. Despite the high level of upfront payments for new streams, the company maintains a self-funding growth model. Through the first 9 months of 2025, the company made upfront cash payments totaling $692 million, including $156 million for Kone, $144 million for Salobo 3, and $44 million for Kurmuk. Additionally, a $30 million equity investment was made in Carcetti to support the acquisition of the Himlo mine. On the financing front, the company transitioned to a progressive dividend policy in 2024. Quarterly dividends were raised to 0.165 per share in 2025, representing a 6.5% year-over-year increase. The total dividend payout of approximately $75 million per quarter is covered by quarterly operating cash flow, resulting in a conservative payout ratio that supports both reinvestment and shareholder returns. Estimated free cash flow, pre-investment, for the first 9 months of 2025 was approximately $933.7 million, an 85% increase over the prior year.
Balance sheet analysis. The balance sheet of Wheaton Precious Metals is a primary source of its competitive advantage, providing an investment-grade credit profile that is rare in the materials sector. Liquidity and capital structure.
As of September 3, 2025, the company reported a liquidity position with a cash balance of $1.2 billion and zero total debt. This lack of leverage ensures there is no interest rate risk and allows the company to avoid debt covenants that might restrict its ability to act quickly on new streaming opportunities. The company's liquidity is further bolstered by a $2 billion revolving credit facility, which was extended in 2025 to mature in June 2030. With an additional $500 million accordion feature, the total available liquidity exceeds approximately $3.7 billion. This provides the company with industry-leading financial flexibility to execute large-scale acquisitions, such as the $400 million Hemlo gold stream, without needing to access equity markets or issue high-interest debt. The net debt-to-EBITDA ratio remains at 0.0, a metric superior to most traditional mining peers. Asset quality and impairment resilience. The primary asset on the balance sheet is the mineral stream interests, valued based on the discounted future cash flows of the contracts. For example, the Salobo gold asset alone represents over $2.59 billion in asset value. Because these assets are located in stable jurisdictions and sit at the low end of the cost curve, they are highly resilient to impairments. Approximately 80% of current production comes from mines in the lowest half of their respective cost curves, ensuring that streaming assets continue to generate cash and avoid write-downs even in low-price environments.
Valuation analysis. The valuation of Wheaton Precious Metals reflects a scarcity premium attributed to its unique combination of safe jurisdiction exposure, high-margin cash flow, and a robust growth pipeline. Relative valuation versus peers. As of late 2025, the company trades at a price-to-earnings or PE ratio of approximately 53.8x. While this is a premium to the broader materials sector, it is consistent with the valuation of other top-tier streaming companies. For comparison, Franco-Nevada trades at 43.5x and Royal Gold at 39.1x. Other valuation metrics also reflect this premium, such as an enterprise value or EV to EBITDA of 36.1x for WPM compared to 22.1x for Royal Gold. The market's willingness to accord a high multiple to Wheaton is driven by its growth alpha, projecting 40% production growth by 2029 compared to more conservative targets from peers. Furthermore, the stock has shown significant momentum, with a 52-week gain of approximately 110% compared to Franco-Nevada's 78% over a similar period. The company's price-to-book ratio stands at 6.2x, which is a premium over both Franco-Nevada, 5.5x, and Royal Gold, 5.5x. Intrinsic value and DCF analysis. A discounted cash flow model, which accounts for the projected 40% growth in GEOs and the long-term production average of 950,000 GEOs after 2030, yields a fair value estimate of $133.22 per share. At a late 2025 price of approximately $117.52, the stock remains roughly 11.8% undervalued, despite its triple-digit year-to-date run. This implies that the market is not yet fully pricing in the long-term cash flow potential of pre-development assets, such as Copper World, which has been recently de-risked via joint venture agreements.
Revenue composition and strategic diversification. The composition of revenue has seen a strategic shift in 2025, with gold assuming a more dominant role in the portfolio mix. Metal mix and revenue contribution. In the second quarter of 2025, gold accounted for 65% of revenue, $328 million, followed by silver at 33%, $166 million, and other metals like palladium and cobalt at 2%, $9 million. This is a notable reversal from the same period in 2024, when silver accounted for 61% of total revenue. The shift is driven by the production ramp-up at Salobo, gold, and the commencement of production at Blackwater and Goose, gold. For the investor, this increased gold weighting provides exposure to a more liquid and less volatile asset class, while silver remains a potent kicker for outsized gains in bullish environments. Jurisdictional exposure. The portfolio is concentrated in the Americas, which accounts for the vast majority of current production. Brazil represents 42% of revenue, primarily Salobo, followed by Peru at 22.1%, Antamina and Constancia, and Mexico at 22.1%, Peñasquito and Sandominas. Other jurisdictions include Sweden at 4.2%, Canada at 4.1%, and the United States at 3%. While the company has expanded into Africa, Platreef, Kone, Kurmuk, these projects are in earlier stages of contribution. Risk assessment. Investing in Wheaton Precious Metals involves several specific risk factors, ranging from commodity market volatility to the operational performance of its third-party mining partners.
Commodity price volatility. As a precious metals streaming company, the revenue is directly exposed to fluctuations in the spot prices of gold and silver. Because its delivery payments are generally fixed or predetermined at low rates, any significant decline in market prices for these metals would immediately impact its cash flow and profitability. While the business model provides downside protection, it remains sensitive to the broader macroeconomic pressures that influence global demand for precious metals. Counterparty and operational risks. The company does not own or operate any of the mines from which it receives production. Instead, it depends entirely on the successful execution and operational integrity of third-party mining partners, such as Vail, BHP, and Glencore. Key operational risks include production disruptions. Technical failures or labor strikes at partner mines can lead to temporary halts and delivery delays. Ramp-up challenges. The company's near-term growth is heavily dependent on the successful ramp-up of new operations like Blackwater and Goose. Delays in achieving full commercial production at these sites could lead to weaker-than-expected guidance. Jurisdictional and geopolitical risks. A significant portion of the company's current production and growth pipeline is located in jurisdictions that may face political or regulatory instability.
Latin American exposure. Heavy concentration in Brazil, Peru, and Mexico exposes the firm to potential changes in mining codes, environmental regulations, or royalty regimes in these countries. Emerging market expansion. Newer investments in jurisdictions like Ethiopia, Kermuk, and Côte d'Ivoire, Kone, carry higher geopolitical risks compared to established mining regions like Canada. Legal, tax, and regulatory considerations. The primary non-operational risks facing the company are related to international taxation and a multi-year audit by the Canada Revenue Agency, CRA. CRA tax dispute status. The CRA has issued reassessments for several tax years, totaling $245 million, contesting the tax treatment of the company's international subsidiaries. The company has appealed these assessments and is currently in the litigation phase. As of late 2025, the company has deposited $62 million as security. While the litigation is expected to be lengthy, management's refusal to provision the full amount reflects their high degree of confidence in the legal merit of their position. Global Minimum Tax Implementation. The enactment of Canada's Global Minimum Tax Act, GMTA, has introduced a 15% minimum tax for multinational enterprises. In 2024, the company recorded a $114 million current tax expense related to this 15% minimum rate on its previously low-tax Cayman Islands subsidiaries. The implementation of GMTA effectively removes a major regulatory overhang, as the company's tax structure is now aligned with international Pillar 2 standards.
Market and valuation risks. The company often trades at a significant premium relative to its peers, with a price-to-earnings ratio frequently exceeding 50x. This high valuation leaves little margin for error. Any downward adjustment in production guidance or earnings misses can lead to rapid price corrections. Additionally, high trading volume and its status as a premier hedge against inflation can lead to increased volatility driven by speculative trading. Future growth catalysts and development milestones. The roadmap to 950,000-plus GEOs by the early 2030s is defined by several key development milestones scheduled for the next 36 months. The Platte Reef expansion, South Africa. Ivanhoe Mines' Platte Reef project is expected to be one of the company's largest future cash flow contributors. Phase 1 is set to begin production in Q4 2025, delivering approximately 100,000 ounces of 3PE plus AU32. Phase 2 is expected to increase processing capacity fivefold by Q4 2027, with a Phase 3 long-term potential to double production again to over 1 million ounces annually. The Kone and Kermuk projects, Africa. The company's $156 million investment in the Kone project, Côte d'Ivoire, and the $44 million investment in the Kermuk project, Ethiopia, signify a successful expansion into the African gold sector. These are high-quality, large-scale developments that provide the organization with substantial long-term optionality in new jurisdictions.
Growth in 2026 and beyond. Beyond the current production ramp-up at Blackwater and Goose,
the company will benefit from the expected first gold at the Marmato expansion, Colombia, in the second half of 2026, the resumption of production at Aljustrel, Portugal, in Q3 2025 also adds immediate incremental silver production. Conclusion: Wheaton Precious Metals Corp stands as a uniquely positioned financial vehicle, offering investors a rare combination of 40% medium-term production growth, industry-leading 55% net margins, and a fortress balance sheet with zero debt and $3.7 billion in total liquidity. The streaming model has effectively decoupled the company's financial success from the inflationary and operational risks inherent in the mining sector. While the current valuation metrics trade at a premium to historical averages and mining peers, this premium can be motivated by the company's pure-play precious metal status and its de-risked development pipeline. The implementation of the global minimum tax has resolved a major regulatory uncertainty, and the robust cash flow coverage of the progressive dividend ensures a consistent return of capital to shareholders. The primary catalysts for the stock in 2026 will be the successful ramp-up of the Platreef and Goose mines, continued grade outperformance at Salobo, and the potential resolution of the CRA dispute.